Are we live? We're live. Finally. Okay. All right. Welcome back. Welcome back to the channel. This is Altcoin Era, and this is your boy Ahmed. And today we're going to look into the FOMC meeting, and we're going to find out what's really going on. At the moment, we have cuts. We've got massive cuts of 50 basis points, a whopping 50 basis points. So that's massive already. That's huge news. And already the S&P 500 has gone up 40% at the moment. Just bear with me while I just broadcast it on Twitter. Just give me a minute and then I'm gonna go straight into it. How you lot doing? You all good? Everyone good? Let me just let everyone know, and then we can carry on with the show. But so far, looks very bullish. The markets look extremely bullish on 50 basis points. The initial reaction, looks bullish, but we'll see. There's going to be a massive volatility, so we'll see what happens next. Just bear with me. I think I'm live. Anyway, let's see. Okay. All right. Let's see. Am I live? Yep, I'm live. Okay. Content. I hope everyone's having a lovely day. I hope everyone's having a lovely evening, and it's gonna be a wild ride. Markets are crazy. How did I do this last time? Oh, okay. Has it started? Oh, almost started. It's gonna be tense. It's gonna be really interesting. Should be live in a couple of minutes. Okay, we're live. We're live. Let's go. Let's go. Let's go. All right. So, what's gonna happen? What's gonna happen? So we got some bad news, and the bad news, we got some good and bad. Okay. So it says right here, it says we have. Let me get rid of this. Hold on. Just bear with me. Bear with me, guys. Bear with me. We have. Where are we? Where are we? What was I trying to do? My mind's gone blank. Hey, just bear with me. I'm getting used to this live streaming stuff. Bear with me, guys. Have some patience, yeah? Oh, yeah. There we go. There we go. Oh, he's live already. He's here.
In a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so.
Really doing good.
We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance.
Yeah, the Fed is behind the curve.
We are not on any preset course. We will continue to make our decisions meeting by meeting.
Yeah, they're behind the curve to me.
We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy
Markets are heading back down.
Inflation persists,
they're heading back down at the moment.
More slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
Let's look at the 15-minute
The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
They're behind.
So, okay, a lot of questions in there. Let me jump in.
So, no laughing now.
Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those.
To be honest, this is bullish. The market wanted to see 50 basis
points. We went into blackout and we thought about what to do, and we concluded that this was the right thing.
Overall, this is bullish,
for the
but
people that we serve,
for our altcoins, it's not really seeing a massive effect.
What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So, a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, and they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance
this was
we
really
adopted
unexpected,
in July
to be fair.
of 2023
This was actually unexpected.
came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. What you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard?
Last question, and I'll go into my segment.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout.
Why?
And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple
Yeah, we're
cuts
dropping.
this
We're
year.
dropping. The
All
markets didn't
19.
like that.
That's a big change from June, right?
The Fed is not
7
in
of
control.
the- 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that.
Okay, so basically, I want to show you something here. The market has never ever been this uncertain about the Fed interest rate cuts. If the Fed cuts to 25 basis points, it will mark the largest surprise seen since 2008. So, on the other hand, if the central bank cuts 50 basis points, it will mark the largest surprise since 2009. So basically, the last time they done this was in 2009 and 2008. It's a big surprise. It's a shock. Honestly, it is a shock. And if you look at the CME watch tool, there was a massive divide. There was a divide between the cohorts that wanted to see or predicted a 25 basis points, and then another cohort that predicted a 50 basis point cut. So in the end, they went for the majority, and which is the 50 basis points, which is surprising indeed, because to me, it looks like the Fed is in the back foot. It looks like they're behind the curve, which I've said before, they should have cut in July. I was talking about this before, and I said they should honestly have cut during July. Unfortunately, right now, they're lagging. So who knows? They might even do another 50 basis points if unemployment increases. And the market so far has kind of been undecided. Like, we don't really see any massive swings up or down. It's the 15-minute chart, and they've been speaking for the past 30 minutes. So the market, I think, is a bit undecisive as well. They really don't know what to make of it. BTC is still hovering at $60,000. We wicked all the way to 61,000, and now we're just moving sideways. I think there's a bit of confusion. People don't really know what to do with this information, because remember, 59% of cohorts believe that we're going to have a 50 basis points, and 40% thought that we're going to have 25. So it's just right now is break even at the moment. The Fed sounds dovish, but he looks also scared as well. So 50 basis points technically should be a great sign, but it just looks like the Fed is behind the curve. To me, it just looks like they're behind the curve. So this is not really a good sign. And you have to remember, the last time they done a surprise like this was in 2009. That's the last time they done that. So it's gonna be interesting what we see next, to be fair. And I wanted to show you some stats Here is the S&P 500 returns 12 months after the first rate cut. So all here was positive. All 12 rate cuts were positive except for the last two. So 14 in total, and only 2 of them were negative during the first rate cuts. The first one was the dot-com era, and the last one was in 2007. So the stats is definitely poised to the bulls, 110%. I can't deny it. It's definitely on the bullish side. We've only had 2 moments in history where the first rate cuts were negative, and the rest we've gone up 3.3%, 35%, 31%. So in general, rate cuts are very bullish. However, if we see a recession, then of course rate cuts are not bullish. The market right now is pricing the market right now is pricing in a soft landing. That's what they're doing right now. So all of this price momentum, let me get rid of all of this, is pricing in a soft landing. So as of now, we still haven't really broken past the all-time new high, which is very surprising, to be honest. I thought that we're going to close above the all-time new high and make a new high. We only wicked. The Nasdaq is not doing as good as the S&P 500. Dow Jones actually made a new all-time high, which is very good indeed. So there are some information that is bullish. Some of them are bearish. Oh, the VIX is down. Okay, the VIX is down today, 1.42%. What's Papa Powell saying?
Is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand?
I think we're heading to 5%. I think we're heading to 5% by maybe Q1 2025 unemployment.
Further deterioration in labor market conditions if policy is still restrictive.
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that.
He doesn't sound convincing, to be fair. What was I talking about earlier? Why is this important? Why are interest rates important? There's just, for your altcoins, they're very important. The reason why I cover this is because a lot of people don't understand how important macro is. Like, a lot of folks don't understand. Macro is very important, and we need interest rates to come down. Once they come down at a sufficient level, then of course we'll see liquidity come back into the system. You have to understand, a lot of participants that buy altcoins are primarily early adopters, a lot of retail investors, and a small cohort of institutional buyers, institutional investors. But the majority are retail. So it's very important. Retail right now, because of higher interest rates, don't have that much disposable income. So they can't really speculate on assets such as cryptocurrencies, such as the stock market, and so on and so forth. When we have sufficient rate cuts, do we see retail come back into the system, and then they can speculate on things such as Solana, BTC, Ethereum, Doge, AVAX, and so on and so forth. But for the meantime, it's going to be struggling retail. For the meantime, altcoins are going to be struggling. We might be in an era of a long consolidation period where we find ourselves consolidating for quite some time. That's why it's imperative that we get adequate interest rate cuts. Yes, I know your coin is the best thing since sliced bread. Yeah, I know this. I understand it's the best thing you've ever seen in your life, and it's going to make you millions upon millions upon millions and millions. Hopefully one day. But for now, ladies and gentlemen, we need interest rate cuts, and we need them fast, because a lot of coins that we see have gone down from peak to trough 85%. Once we get sufficient rate cuts, do we find ourselves in an easy market? Making money is going to be very, very easy. Sorry about the plane. And so we find ourselves, BTC dominance is heading up once again. It's going higher and higher. But you know what's crazy? Do you know why mainly this is going up higher and higher? It's because of Ethereum. Most of our altcoins have been punished and beaten down and beaten down and beaten down. However, in the end, even the giants must fall. And that, my friends, is Ethereum. Ethereum is the last giant to fall. And that's why BTC dominance keeps on going higher and higher. We're having a capitulation moment with the second biggest cryptocurrency, which is Ethereum. And I understand Ethereum is getting a very, very bad press. It's getting very, very bad press at the moment. However, this is all part of the cycle. This is literally all part of the cycle. And as I said, at the moment, I think everyone's kind of in the market. Everyone's kind of like, you know, when they're all just staring at each other, like, what should we do? Like, is this good? Is this bad? Like, I think everyone's kind of confused because I think we're going to close on an indecisive candle, which basically means a sideways candle. And whoa, VIX is up. Easy, buddy. Ooh, 7% in just in 5 minutes. Whoa, buddy. Are you? No. What happened there?
It's now below around 1, but that's still a very good number, I would say. You know, quits have come back down to normal levels. I mean, that could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And you know, so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
You know, more data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting. I think. No, on the Friday before the meeting.
He seems scared. What's wrong with him?
So, and inflation data. We'll get all this data. We'll be watching. You know, it's always a question of look at the incoming data and ask
nervous.
What are the implications of that data for the
Dear Lord.
outlook and the balance of risks.
He seems
and then
nervous.
Go through our process and think, what's the right thing to do? Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
He's nervous.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk?
I guess he calmed the market down, so we're going to have to wait and see until tomorrow. Let the dust settle, and then we're going to find out what's really going on. As of now, there's going to be massive whipsaw effects. That's it for now. Make sure you like, subscribe, hit the bell notification button, and click on the description below. My private members, we're having a sale. Join my private members. You're going to enjoy it. Peace.